Hello and welcome to today's webinar. Are you looking to buy a business? My name is Sharon Adey and I'll be your moderator. Thank you for joining this session today, where we aim to provide you with an overview on the buying process, the tools and resources that are available to assist you when making a business acquisition or merger, and some useful pointers to help you successfully access finance should you need to. Before we start, I have a few housekeeping items to cover. First, we'd love to hear from you during today's presentations. If you have a question for our speakers, please feel free to send it through the Q&A tab at the top right of your screen. This can be submitted anonymously if you would prefer to do so. We'll be answering questions at the end of the session, but if we don't get to your question during today's webinar, we will be sure to follow up afterwards. Also, just to let you know, today's webinar will be available on the Jerroms website after the live session. I'd now like to kick things off by welcoming Paul Heaven from Jerroms Corporate Finance. Paul, over to you.
Good morning, everybody. Thanks for joining us today. As Sharon has said, this is a webinar really on the issue of, or the process I should say, really involved in buying or targeting the acquisition of a company. So what we're going to run through today is a brief process, a run through the process. We're going to take a look at the tax implications. A colleague of mine, Nick Wright, is going to join us to talk about the tax implications, and then a very good friend of the firm, Jeremy Parkin at the Wilk Partnerships, is going to talk us through some of the legal ramifications. Myself and my colleague Steve Grice will pick off the process part and how it's handled. Okay, so brief background to me is some of you may know me better from my prior service with Blue Sky Corporate Finance. We merged with Jerroms to establish Jerroms Corporate Finance in October of last year, and we've been working on, I've certainly been working on mergers and acquisitions deals for more than 20 years and many hundreds of transactions. If you are looking to buy a business, and this may seem like an odd time to buy a business, it isn't really. I mean, given what's going on in the economic environment and the world out there, you know, this is probably a time where you might want to seriously consider whether there is, you know, a potential way of developing your business or growing the opportunity through buy. We're going to be covering off the key components, which is how to identify an acquisition target. We're going to be looking at how the valuation process might work, how to assess the funding structure, getting to the heads of terms. As part of that process, Steve's going to jump in and talk to us about how to secure the finance required. I'm going to touch on due diligence. Nick's going to come in and talk about optimizing the tax implications, and then, as previously noted, Jeremy's going to come in and talk to us about some of the legal ramifications. Now, you'll find that I don't read from the slides, but the slides will be available to you afterwards. So I guess probably the key first message to get across is there is a pretty well tried and established process for making an acquisition of a business. That's not to say it isn't nuanced in the case of each deal, but there is a pretty well established process, and what we're going to run you through is the pillars and the key steps involved in that process. Now, that's quite a busy slide. I'm not going to cover it off in that level of detail, but the slides will be available after the event should somebody want to study it in more detail. So the first phase of the process, really, which is down here as the planning phase, is how we go about identifying potential targets for acquisition, and then how we kind of step through the process of getting to the valuation point. Now, in terms of identifying the targets, again, no fixed and firm rules, but there are kind of three perhaps most common methods of doing it. The first is entirely tactical, where you may be aware of a potential acquisition before you even approach a firm like ourselves to structure the deal. So that might be a friend of a friend, a customer, a supplier, even a competitor that's let you know that they're looking to consider retirement, could be somewhere you've been tipped off. So it's not uncommon for us to be involved in helping to shape a deal where you've already got an acquisition in mind. But if we're engaged, or a firm like ourselves is engaged in the search of potential targets, there are again probably two approaches to that. Both of them kick off with the same element, which is for you to identify, or help us to identify, what it is that you're looking for, the deal criteria, if you like. So clearly what sector or trade you're in, what your geographic preference might be for the target, which could be, national, local, regional, or even international. Jerroms is part of the Russell Bedford network, so if you're looking to make an acquisition out with the UK, then that's something we could also help you with. It might be, the criteria might be size, turnover, profitability. There are any number of factors which may help us to work with you to determine the identification. And then within that process of identifying targets, there's a kind of tactical approach on our part, which is to go out to look for and search for companies where we know they are for sale, either because they've been mandated through an organisation like our own, and they've identified their willingness to sell, or because we'll reach out through other accountants and lawyers to identify companies where we know that those businesses are for sale. But we can also do a strategic search, which is where we work with you and use the tools that are at our disposal to identify potential targets. So as long as we know what sector you're looking for and those broad deal criterion, then we can help you to identify companies that match and meet that criterion. So having got to the point where we've identified a target and sucked in as much information as we can, we're going to be then advising you on what the valuation and the deal basis might be. Let me touch on both of those. So valuation, lots of different techniques that are used, and indeed we'll very often use more than one technique when we're looking at what the potential value of the acquisition target might be. The most common, obviously, some kind of an earnings-based or asset-based valuation, but we might also be looking at some kind of a multiple of recurring or annuity income. We might be looking at intellectual property rights. So there's any number of methods, and as I say, we'll probably identify more than one to seek to get a kind of range of valuations. But I also mentioned the words the deal basis. There are a number of potential ways in which a deal can be done and structured. And again, without going into them in detail, that would almost be the subject of a webinar of its own. We could be looking at a net nil balance sheet, we could be looking at a debt-free, cash-free basis, or we could be doing some hybrid of the two. Steve and I are working on a deal at the moment where part of the inventory involved in the company that's being acquired is being left with the vendor to as part of the deal structure. So hybrid deal structures are quite common. Having got to the point where we've identified a target or some targets and we've got a potential valuation in mind, and the next stage is to approach the vendors and start to engage in the process itself to see where we're at in terms of how the deal might be best structured. Now, it's clearly important that we at this stage have a mindful of the way that the transaction is going to be structured. This process itself, this phase 2, is where we reach out to the vendors, we start to engage them. Where necessary, we secure additional information that's required. We're clearly not yet at a point where we've actually appointed somebody to finance the deal, but we're clearly at a stage at the moment where we're looking to make sure that the finance structures are within the art of the possible, within the realm of the possible. Now, this stage leading up to and approaching due diligence is where we structure the heads of terms. So we'll make an offer, it's on your behalf obviously, but we'll make an offer. It is not uncommon that process can be refined or fine-tuned or go through a process of iterations, and ultimately what comes out of that is a document called the heads of terms. Now, Jeremy will cover that more detail later in the legal part of the process, but suffice to say at this stage that the heads of terms need to be at sufficient detail for for the avoidance of arguments at the stage when we get to the legal process. So it is quite important that we get that. Now, a key component of the heads of terms, as well as the deal structure itself and the nature of the offer that we're making, we'll also be looking at establishing a period of exclusivity under which due diligence will take place. Now, due diligence can take all kinds of shapes and sizes and will almost certainly be deal specific. It's kind of limitless in its scope. The two things that are pretty much always part of due diligence is legal due diligence, which again Jeremy will cover, and financial due diligence, which self-evidently and obviously is a service offered by Jerroms. Now, this is about, looking at the key components of the deal, the assets, the working capital, the profit performance, the forecast provided, and so forth, and looking to make sure those are all robust and stable and that you're aware of the risks involved. But due diligence is all about reducing the risk to you as part of the transaction. So other potential streams of due diligence, not necessarily ones carried out by us, but could be customer due diligence or supplier due diligence. You may want even to consider human capital due diligence. People are very often a very important part of the acquisition you're making, and yet human capital due diligence, taking references and maybe running them through psychometric profiling, is still quite rare. So that's an element you might want to consider. We might be looking at a specific issue relating to the deal, a pension or employment, some kind of a litigation issue. So due diligence is a very, very important part of the process, and it's absolutely key for you and indeed for any funders involved in the structuring of the deal, for that to be the case, for that to take place. I'm now going to hand over to my colleague Steve, who's going to talk you through the financing of the deal.
Okay, morning everybody. I'm Steve Grimes. Funding of these kind of deals. So Paul, if you can move on slides, please. Okay, so we provide the full range of acquisition funding advice, and it's specifically around these type of transactions. We've got a lot of experience in funding these sort of things, and we know which particular lenders are good for particular deals. We'll generally select 2 or 3 lenders from our contact base to take a particular deal to. Every lender has different flavour, different kind of appetites, different concerns, and it will become fairly evident from the deal which particular type of lender, which particular exact lender a deal will suit. And we'll take the process through right from sort of the initial, this looks like a deal that you can finance, right through to final negotiation and negotiating terms and conditions, and other bits and bobs around each particular lender. So to give an overview of the way finance works, if I can have the next slide, please. So there's 2 basic approaches to funding these kind of deals. And I should say one of the things that I missed from the last slide, selection of lenders isn't necessarily just about this particular deal. We work with a lot of management teams who are looking to do several acquisitions and buy and build strategy. So the selection of the lender is not necessarily about the first deal, it's about who's there for the long term, who's going to be best, not for now, but for your next deal, for your next deal, for your next deal. And there are a couple of lenders out there who actively like to back management teams that have that kind of approach. So onto this particular slide, there are 2 basic structures, 2 basic ways of funding acquisitions. The first is the standard asset-based lending structure. So here you're using assets in the balance sheet to raise funding, which is typically debtors, stock, plant and machinery, the normal sort of thing. So it's an invoice discounting line, it's asset finance, it's stock finance. And there you've got 3 or 4 separate loans, all come together in a kind of jigsaw finance kind of approach. typically from one lender, because using one lender for that kind of approach, you can tend to lever a bit more cash out of the deal. The assets on the balance sheet, generally, we tend not to include property in that. If a business that you're looking to buy owns property, generally that's pushed to one side, that's separated out. There's all sorts of strategy questions around that, like do you want to buy property or do you want to invest in the business? The key thing for the finance is, although property is very good security for a lender, typically it's a completely different type of loan with a different profile, different interest rates, different pay downs, and crucially, you're still going to have to put in a fairly big deposit, typically 25 or 30%. So if you're looking to do property, you're doing property. If you're looking to do a business, you're doing a business. That's kind of the way we find it. If you are going down the asset-based lending route, so you've got debtors, you've got stock, you've got plant and machinery, and these will be all valuation based around the balance sheet. So typically debtors, you might be able to realise 80% of the value that's on balance sheet. Stock, you might only realise 30%. On top of all those, if there's still not quite enough cash generated for to complete the deal, some lenders will also put a small cash flow loan on top. Typically, it's not much. It's going to be some sort of percentage on what they're advancing on the other types of loans. Generally, 1 times EBITDA, something like that. Some lenders also have the potential to use C-bills to facilitate that as well, because you can use C-bills to do acquisitions. This particular approach, the asset-based lending approach, tends to suit businesses where the balance sheet is asset rich. So manufacturers, hauliers, that kind of thing. It better suits businesses where you've got some volatility in EBITDA. It suits maybe turnarounds, projection-led, businesses that aren't sort of steady and stable. Now, the other approach is the straightforward cash flow loan. This is what was very prevalent in the early 2000s. A lender will lend to acquire a business, and the amount of the loan is generally a multiple of the 3-year average EBITDA. So it really suits businesses where you've got fairly strong, fairly stable performance, churning out predictable profits year after year, and that's established just by the due diligence, by looking back at the accounts. Fairly stable, standard. You're looking for a business that isn't exciting. You're looking for a business that's fairly profitable. It tends to suit larger deals. So rather than you're looking to raise a couple of £100,000 to do the deal, 750,000 and above is where this kind of funding really comes into it. So as long as the target business ticks those kind of boxes. I think we'll have the next slide, please. Okay, so a little bit here on what lenders will expect from you. Generally, the big thing for lenders is alignment of risk. So they will want to see some equity cash in from the buyer, from you. That varies depending on particular lender. In exceptional cases, you can get away with putting anything in, but as a rule, you need to be looking to put in 10 to 15% of the deal value. They will also look for alignment of risk from the vendor, which means deferred consideration. I think we'd never advise anybody to buy a business without deferred consideration if it's possible, because that also decreases your risk as well and keeps the vendor tied into the business. They're not going to go up and set a competitor, or they're not going to take key rights away, etc., etc. Another point lenders will be looking for is a good management team. So if you're coming in to buy a business, have you got experience in the industry? Is there a good second-tier management team in there that can support you as you come to understand the business, etc., etc.? One of the key things around that is, does the business provide good financial information at the moment, or is it kind of back of the fact packet? The owner knows what's going on in their head. businesses that will be attractive to lenders are the ones that are able to produce settlement and management figures every month and have been doing so for a number of years. So that can also be used to feed into the price, into the valuation as well. It's an opportunity to negotiate. There's some key differences in expectations between the different types of lenders, whether we look at the ABL approach or whether we look at the cash flow approach. The asset-based lenders are going to be more focused on what's the state of the balance sheet, whereas the cash flow lenders are going to be more focused on the ongoing performance of the business. And by that, they generally take past performance to be over future performance. They'll be looking at things like, are there long-term contracts in place? Are there concentration issues? What's the market outlook? One particular sector at the moment that's quite difficult to fund is construction. So you might have a very profitable, stable business in that sector. The outlook for the market is probably one of volatility, and we know the construction sector tends to lead in and out of recessions as well. So it's one that cash flow lenders in particular tend not to like because of the volatility. I think that's concluded my bit now, so we'll move on to the next slide.
Thanks, Steve. Appreciate that. So, key message there is there's plenty of finance out there to do deals. It's likely to end up being a kind of blend of different forms of finance to support your ambitions on an acquisition. But again, you know, we're there, we can help you and run you through that. We're now into phase 3, and in the interest of time, I'm just going to kind of skip through this. I mean, clearly there's, you know, we've been through heads of terms now, we've got a deal, we've done the value, we've structured the finance. Hopefully the heads of terms have survived the due diligence process, but if they haven't, then we need to look at anything that came out of due diligence that causes us to either look back again at valuation or maybe additional due diligence, or possibly even to hand over to Jeremy and his team to deal with in the context of the legal documents in terms of warranties or indemnities and so forth. So the due diligence process has helped us to de-risk it. We're now into the final leg of the process. Our role really during this phase becomes one of project management, of making sure that documents are obtained and filed in what's known as the data room, that the lawyers are getting on with the drafting of the documents correctly, that there's you know, appropriate liaison between the two legal teams. I guess key to this phase of the process is to make sure that deal fatigue doesn't slip in, because you know we've been through a lot of work now. This is the final running stage, and as I say, our role becomes that of project managing the process through to what will hopefully be a successful completion. During this stage, there can quite often be some thorny issues that need to be kind of teased out and negotiated between the parties. And again, it's easy to use us for that role rather than you know, for you to do that directly with the vendors, not least because you're going to have to live with them and work with them for some years to come in most instances. So this is the kind of final phase of the deal. I'm now going to pass the baton over to Nick. So that's the process which we've gone through before. I'm now going to pass the baton over to Nick, who's going to talk to you about some of the tax implications.
Thanks, Paul. My name's Nick Wright. I'm Corporate Tax Manager here at Jerroms. And I'm just going to run through the tax implications of buying a business, and more specifically the key differences between the two main methods of doing so, which is an asset purchase where you would just buy the specific assets of the company that you want, or a share purchase where the buyer will acquire the shares of the company, and obviously by doing that they'll acquire all of the assets and liabilities within the company. So moving on to the first slide, the tax consequences of a purchase of assets. Obviously, it will depend on what type of assets we're looking at. So in terms of plant and machinery, the buyer acquiring the plant and machinery will qualify for capital allowances. Obviously, the asset purchase agreement will outline the value attributed to each asset. So capital allowances can potentially be quite lucrative based on the value assigned. Also, there will be potentially some capital assets in there, such as land and buildings. And again, this will be acquired at the market value that's agreed. The benefit of that for the buyer is potentially lower capital gains tax exposure in the future as their base cost is increased to the agreed value now. However, what that does mean is, as they're purchasing land and property, stamp duty land tax is likely to be chargeable on the consideration paid. Another key consequence potentially for tax relief in the future is goodwill. This has changed quite significantly over the past 10 years or so. So since 2015, there's been no tax relief available on the acquisition of goodwill, or what they refer to as relevant assets, which includes items such as customer-related assets and licenses. However, since 2019, there are certain limited circumstances where tax relief may be available. Tax relief in those circumstances is fixed at a rate of 6.5% per annum, but this only applies where, as part of the acquisition, the relevant assets and the goodwill are acquired alongside intellectual property. Intellectual property being things like patents, registered designs, and copyright. Tax losses in an asset purchase are not relevant. The losses don't remain within the original company. So if losses are available, then an asset purchase might not necessarily be the way to go. Moving on to the next slide, then we've got VAT. The default position for VAT is that any standard rated assets will be chargeable to VAT. However, provided the conditions for a transfer of going concern are met, the entire transaction will fall outside the scope. Those conditions listed there, so the whole of the business, or at least a part that's capable of operating separately as a business, must be transferred as a going concern. Those assets must be used in the same kind of business by the buyer. The transferee must also become VAT registered if they're not already, and they must continue any options to tax on any land that the transferor has made. And once those conditions are satisfied, the TAGC rules become compulsory. There's no election to be made. They are compulsory, as I say. And finally, in terms of the tax consequences, employees. From an employee's perspective, where they're transferred as part of a business acquisition, TUPE legislation is likely to apply, so their contracts effectively get transferred over to the buyer. So moving on, the advantages of an asset purchase, which we've touched on most of these. The buyer can cherry pick which assets they want and leave behind any unwanted assets or liabilities. And also from the seller's perspective, if they wish to retain any assets such as investment properties, they can do so by leaving these outside of the agreement. Due diligence in an asset purchase is likely to be less, as obviously the agreement specifies exactly what is being acquired. And also for the buyer, if they have sold any plant and machinery or fixed plant and machinery or land and buildings in the previous 12 months, or they're planning on doing so in the next 3 years, any gains on those disposals may be rolled over into the acquisitions of the same types of assets in this new business. So potential for deferring any capital gains tax charges on other disposals. And as we've already obviously outlined the tax consequences, any capital gains base costs for capital assets such as land and buildings will be reset to market value, so potentially a significant saving to be made in the future. Obviously, that means, as we've talked about in the previous webinar, in terms of selling a business, that capital gains tax will be payable by the seller instead, and also potential relief for capital allowances on machinery. Just a couple of disadvantages then to mention on the buyer's side for the asset purchase. The seller is likely to have higher tax liabilities depending on what we're talking about in terms of what's been included. So they might be looking to be compensated for that by requiring a higher purchase price. And also stamp duty land tax on any land and buildings acquired might become quite significant. Rates can be up to 15% on SDLT, so really need to watch out for that if there is a significant value in the land and property. Moving on then to a purchase of shares and the tax consequences there. Obviously, you are only buying the shares. The assets remain in ownership of the company. And also by doing that, you will also acquire the tax losses that are in the original company. However, there is some anti-avoidance rules that are designed to effectively stop individuals or companies buying other companies purely to make use of their losses. And these are effectively where within 3 years, either before or after the sale, there's a major change in the nature or conduct of the trade. That might be a change in the activities, the markets, the customers, the suppliers, that kind of thing. So that's just something to watch out for if there is significant losses that you're hoping to make use of in the future in the ongoing trade. Also, another minor point is that if the company is within a group, the large company limits are divided by the number of companies in a group for payments on account purposes. So potentially adding another company to the group may put some of the companies into payments on account for tax purposes. Stamp duty is payable. The rate is only 0.5% compared to stamp duty land tax, which is obviously significantly higher, but that's payable on the total consideration for the shares. And just for completeness, I mentioned that is not chargeable on the purchase of shares. So moving on, so the advantages of purchasing the shares, potentially it's simpler to structure the deal that way because all the assets and the trade are already packaged up within the company. Continuity for the business is probably one of the most significant advantages. Company name goes over, etc. And also potentially lower professional costs by following this method as well. Some of the disadvantages, however, the buyer will be acquiring all the liabilities in the company. There might not necessarily be immediately obvious what those liabilities are, if there's hidden tax liabilities, for instance. So that's something to watch out for. And similarly, in terms of buying a business with history, the share purchase agreement will include warranties and indemnities that hopefully will be strong enough to, where there are any unknown liabilities, to indemnify the buyer against those. And as I say before, another disadvantage is that there will be stamp duty payable at about 0.5%, so potentially not too significant. And just moving on to the final slide, there's just a summary here of the differences between the purchase of an asset and the purchase of the shares. And whether the buyer wants to go down either route really depends on what is made up within the company. So as we talked about, if there's SDLT payable on land and buildings, that might become so significant that it'd be preferable to purchase the shares instead. But that would obviously mean not claiming the capital allowances. Whether there's any significant tax losses that will be useful in the future. As I say, it all depends on the specific circumstances of each transaction. So something that needs to be considered in each deal. And that's it from me. So I'll hand you back and over to Jeremy to go through some of the legal side.
Thanks, Nick. Jeremy, do you want to take it from here?
Yes, thanks, Paul. Good morning, everybody, and thanks for joining the webinar today. My name is Jeremy Parkin, and I'm a corporate partner in the Wilks Partnership. As such, I spend most of my waking hours working on the acquisition and sale of businesses and companies. The Wilks Partnership is a medium-sized firm of solicitors based in Birmingham. Most of our clients are SMEs, and we work on a number of transactions, buying and selling businesses with our colleagues at Jerroms. We have 4 partners in the corporate services team at Wilks, and we deal with between 50 and 100 transactions every year. So we're buying and selling businesses on a regular basis. So I can have the next slide, please, Paul. The agenda for day is pretty simple. It's just going through the legal process and how it works in terms of acquiring a business. So without further ado, I'll jump straight in and move on to the next slide, please. So we've discussed the difference between buying assets and buying shares. Just to rehearse that, the main difference is that if you buy all the shares in the company, then you automatically inherit everything in the company. That's all of its actual and contingent liabilities. And the risk there is that you'll find some skeleton in the cupboard that causes you losses down the line. On the other hand, if you buy the assets and liabilities of the business, you get an opportunity to cherry pick what you want, and you can leave some liabilities behind. And indeed, in some cases, it might be useful to leave assets behind. For example, if there's a freehold property in the company, you might not want to spend the money buying that, but rather do a deal with the seller for the seller to keep it and lease it to you for the purposes of the business. Nick's covered the tax considerations pretty well. They used to be heavily driven by something called entrepreneurs relief, which gave the sellers a favourable CGT rate of 10% on the consideration they received, but that's been cut back substantially recently, and it's likely to be looked at further in the budget. But this all feeds into the seller's expectations. If you want to leave liabilities behind, then you might be having to pay more for the business, whereas if you take the whole company, you might get a better deal. The last point, I think, in terms of assets and shares, Nick touched on briefly, is some legislation called TUPE, or the Transfer of Undertakings Protection of Employment Regulations. The effect of this is when you buy the assets and liabilities of a business, TUPE operates to transfer the employees, all of the employees, to you automatically on their existing terms and conditions and with all their accrued rights and benefits. So in the end, it's no different to buying the company. And it's a mistake often made by clients that they think they can slim down the workforce in advance of a sale of a company, or the buyer thinks that can be done in advance of buying the company. But in fact, that leads to a very high risk of unfair dismissal claims. So if you are buying a business and you think you need less people than are in it at the time of acquiring it, then you need to look at costing those redundancies and deducting the cost of those redundancies from the purchase price, because the best way of dealing with the redundancies is for you as the buyer to do them once you've bought the business. We can move on to the next slide, Paul, please. So once you've identified what you're buying, you need to reduce the key elements of the deal to written form. And this is a sort of short form heads of terms, or heads of agreement it's called. It should be drafted by your professional advisors, and it should contain all the key elements of the transaction. So most of that is fairly obvious, but you'll want to put in some protections relating to the assets and the business that you're buying. So for example, if you're expecting a certain level of net assets or working capital, then you need to draft that into the heads of terms and maybe draft in some sort of price adjustment if the net assets are less on completion than you expected, or the working capital is different. What this heads of terms does is it provides a good pointer for the solicitors on each side to draft the main documents. So you're reducing the risk of costs being spent on the lawyers drafting away without actually the key terms having been all properly agreed. Another thing you'll want in your heads of agreement is to consider an exclusivity period. So what you'll be asking the seller for is a commitment that the seller won't negotiate with anybody else in relation to the sale of the assets or the business, typically for a period of 2 to 3 months, and that should be sufficient time for you to get the deal done with the seller. And that's another way of avoiding risking wasted costs because you're in competition with somebody else to acquire the business. The heads will probably also set out the process for legal due diligence and target a completion date so that the parties know what they're working to. Next one, please, Paul. Great. So legal due diligence will be run alongside the commercial and financial due diligence. It's essentially a legal review of key aspects of the business. The lawyers will have a standard form set of what are called due diligence inquiries, which is a long list of questions which we're asking the seller's solicitors to respond to with the help of the seller. And typically this results in a document coming back to us with all the answers to the questions on, but a whole set of documents which support the questions and the answers, and these are all put into a data room which can be generally done online these days and viewed by the solicitors and the clients. The legal due diligence needs to focus on the relevant key areas in the business. So, for example, if you're buying a software company, you want to know all about the intellectual property rights. You want to know who wrote the software, who owns it, and make sure that the business you're buying has all the necessary rights to it. So the legal due diligence is a fact-finding and risk assessment process. It'll end up with a report being prepared by the solicitors as to their findings from the due diligence inquiries and the answers they've received from the sellers. And rather than having a big long report about everything, we prefer to do what we call a report by exception, which is essentially just highlighting to you, the client, the buyer, areas of concern, unusual aspects of the business and matters which give rise to a risk to you as the buyer. And some of that information obviously may be relevant to pricing and may enable you to go back to the seller and negotiate some kind of discount if it's a serious issue. Can I have the next slide, please, Paul? So moving on to the main documents for the transaction, there's the sale and purchase agreement, which kind of does what it says on the tin, and there's something called a disclosure letter. In the sale and purchase agreement, there'll be a schedule of warranties, which is a long list of statements or representations made by the seller regarding all aspects of the business. So, for example, they'll warrant you that there's no litigation, that the company's not involved in any disputes, and such like. So it's all to do with compliance and the legal aspects of the business. If it's a sale and purchase agreement for the sale of a company, then there'll be a tax covenant, and that typically makes the seller liable for all taxation which is payable in respect of the company for the period right up to completion. The disclosure letter is the opportunity for the sellers to tell you about any issues in the business which are not consistent with the warranties. So, for example, if they're warranting that there's no litigation in the company, but in fact there is some kind of claim the company's involved with, that will be disclosed together with details in the disclosure letter. Once it's disclosed, then you don't have a claim for breach of warranty. So if it's a significant issue, you'll need to look at putting a specific indemnity in the SPA, which holds you harmless against any costs and losses you may suffer as a result of that matter, whether it be a litigation or whatever else. The last important thing in the sale and purchase agreement will be a non-compete provision. So that is an obligation on the sellers not to compete with the business they've sold to you or the company they've sold to you, typically for a period of 3 years. They'll also be agreeing not to solicit customers and not to poach staff from the business you've bought. Next slide, please, Paul. In terms of structuring the consideration, we've discussed that earlier. There are all sorts of ways of funding the acquisition, but generally there is a substantial upfront payment and often some deferred consideration. So Steve talked about using the target's cash and receivables and other assets to help fund the deal, and talked about bank funding which may be available for the acquisition. Where there is deferred consideration, so you're paying some of it later, it's often structured by way of loan notes, and these are effectively an IOU from the buyer to the seller, saying that you, the buyer, will pay specified amounts on a quarterly or annual basis, generally together with interest. And structuring it this way often has a tax advantage for the sellers. You may also want to look at an earn-out, and obviously that entails a performance-related payment of consideration. So you might look at the business over the first year or 2 years and have an element of the consideration which is calculated by reference to the profits of the business for that period. Again, that introduces a further level of complexity, but it's something that we're used to dealing with, and we work with our colleagues at Jerroms to document that properly for you. Finally, in terms of the cash and the money, you want to ensure that if you've got any claims under the sale and purchase agreement, say a claim for breach of warranty or a claim under an indemnity, if there's any deferred consideration, you want to be able to set off your claim against the amount of that deferred consideration so you don't pay it in full. I think we can move on to the next slide, please, Paul. In terms of post-completion issues, obviously transition and handover of the business is important. So you may want to engage the sellers or one or two key people from their organisation in a consultancy agreement or something like that to help hand over the business and transition the customer base to you. We'll also want to look at any issues which have arisen during the course of the due diligence. So, for example, if the employment contracts are no good, or there's a big supplier or customer and no proper contracts in place, you might want to address that. You also have to look at the senior management and how you're going to retain them and incentivise them. So probably you're looking at new service agreements for the senior managers. You want to look at bonus schemes, and you may want to consider share option schemes, which are available in a quite tax efficient form through what's called an EMI scheme. Yeah, I think we can move on to the last one, Paul, thanks. So just briefly to touch on distressed sales, because that's fairly topical at the moment. Typically, this is where a company's insolvent and may well have appointed administrators to dispose of the business, or be about to appoint administrators. Normally, they're working to an accelerated timescale because there's not usually the funding to keep the business going. This means that you've got a very limited opportunity to do your due diligence, and when the sale and purchase agreement appears, it'll be drafted by the administrator's lawyers, and they won't be giving you any warranties at all about the business. So it's quite a high risk transaction from a buyer's point of view. The big virtue of it, of course, is that you get a very low price typically. And we've worked on a number of deals over the years where clients who know the business, know the sector, are able to move quickly, have cash to fund that type of acquisition, and have done very well out of it. So that's something to consider in the current climate.